Advanced tax strategies, an in-depth exploration of the Deferred Sales Trust. Hi, I'm Brett Swarts, founder of Capital Gains Tax Solutions, and in this video, we are diving into the Deferred Sales Trust and how it can help you exit highly appreciated assets so you can defer capital gains tax and create and preserve more wealth, or help your clients, friends, and family do the same. Let's face it, in the arena of tax management, there's complexity, there's uncertainty, and oftentimes when you're exiting highly appreciated asset, you only have a short period of time to make a huge decision for the financial future of your wealth. But there are certain strategies that can enable you as the owner of an asset to defer capital gains taxes and to unlock a flexible wealth plan. Here's the key. You need to have wise financial consultants, a wise financial team of professionals to help you execute these strategies. And that's what we're going to be covering in this video. In particular, we're going to be diving into the Deferred Sales Trust strategy and how it's a notable tool in this modern financial planning. Right now in the marketplace, we're seeing a number of things that are changing all at once, and they're converging into what we call a perfect storm. We have a large amount of baby boomers that are looking to exit highly appreciated assets that they have accumulated over 10, 20, 30 years, mostly high-end primary homes, private equity and businesses, and commercial real estate. You also have another emerging amount of wealth that's been accumulated in a rapid pace with cryptocurrency. And each segment of different investment classes are facing huge capital gains taxes, which brings everyone together today to consider a better way to invest, to diversify your wealth, and to exit on your terms. And so the Deferred Sales Trust is a great way to safeguard your wealth in an efficient way. It helps with estate and capital gains tax challenges, and it helps to unlock a wealth plan that gives you time back to make great decisions. And so a lot of wealthy individuals are constantly looking for ways to safeguard their assets, whether it be asset protection, whether it be just capital gains taxes and ways to defer that, or eliminating estate tax. So the fear of high capital gains tax, which is somewhere between 25 and 50%, often discourages sellers from selling highly appreciated assets. Let's look at the cryptocurrency market. What happened on the last kind of crash of the cryptocurrency market? A lot of people weren't selling because of the capital gains tax. We've been fortunately been able to help people exit cryptocurrency, defer the tax, and diversify the wealth using the Deferred Sales Trust. And that's a great reason to consider safeguarding your wealth in today's times. As well, commercial real estate. Let's look at the 2008 crash. What happened? Well, I think a lot of people before 05, 06, 07, 08, they were overpaying for properties because they felt trapped by the 1031 exchange, and they were using the 1031 to defer that tax, but oftentimes they would not have purchased those properties if it wasn't for the tax. And so you want something that's going to give you relief from the pressure of making quick decisions. Right now, let's fast forward here in late 2023, we're looking at a similar circumstance where people are selling assets, wanting to buy other assets, but it doesn't make much sense for them because the debt is so much higher than it was just a year and a half ago. And so they're looking at cap rates that are now lower than the interest rates, right? In other words, it's an inverse relationship of what it used to be. You used to be able to borrow less than your cap rate, where now you're having to buy something typically where you have negative arbitrage, right? Your interest rate that you're borrowing at is greater than your cap rate, which is not good. And so this often discourages sellers from selling because these highly appreciated assets aren't necessarily going to put them in a better position on their next run, either on 1031 exchange. And so the need for intelligent and intricate tax deferral tactics is paramount. In fact, we call this tax flow. Tax flow is more than just cash flow. Cash flow is perhaps what you've been focused on for a long time, but given that we have $32 trillion of debt, given that the government does, and I guess we as U.S. citizens do, if you're watching this, you're a U.S. citizen, we're looking at a huge amount of debt to pay off over a huge amount of years moving forward. And if we don't have great tax flow strategies, guess what? We're going to all be in a tough position. So you want to make sure that you're unlocking tax deferral strategies like the Deferred Sales Trust so that you can create and preserve more wealth versus it being taxed and gone forever. And so the role of the deferred sales trust, let's dive in a little bit deeper here. The deferred sales trust is a strategy that's an alternative to a 1031 exchange. In other words, you don't have to face these short time frames where you're having to buy or identify a property within 45 to 180 days. And also you're having to stay in the same asset class that's not diversified. And so what's beautiful about it is it eliminates the need for the 1031 exchange, and it's an alternative. It can also rescue a failed 1031 exchange. And it effectively overcomes the challenges associated with the like-kind property, providing means not only to defer capital gains tax, but it uses an IRS proven tax strategy that goes back nearly 100 years, mainly IRC section 453 of the tax code, which allows for structured tax deferral through basically an installment sale, also known as a seller carryback, which allows you to potentially grow your wealth, live off the interest of what you would have paid in tax. It's sort of like an IRA and a 401k. Think about it. If you have an IRA or a 401k, you are delaying, let's say, gratification to spend that on personal consumption, and you're investing it into other investments and allowing that to grow over time, and therefore deferring the tax, which can help you to grow your wealth long term. And then as you start receiving payments later on in life, you're going to pay tax. And so similarly, that's how the deferred sales trust works. And it allows you to grow your wealth in a compounding way. Let's talk about interest rates and the investment growth of the deferred sales trust. So these installment notes, which if you are a seller who are selling, that's what you're receiving in exchange for selling. You're carrying paper, or you're becoming the bank for the trust. These notes are structured in a way usually determined by your risk tolerance as the seller, and they're ranging somewhere between 5 and 9% compounding, typically net of recurring fees. Now, this creates opportunity for the structured growth and deferral of the tax. Again, it's kind of like the IRA, and it's aligned with your specific needs of cash flow, and it's tailored to your specific risk tolerance. So the deferred sales trust process is a two-phase approach, by the way. And this process starts with really two critical phases, each ensuring proper legal and financial compliance. You want to make sure that you're doing everything in the right order, because the biggest thing we found for deals not closing is time is restricted, and there's multiple parties that you've already committed to selling your asset, either asset to a seller, but also working with professionals. And the time gets constrained from the time you want to sell, and contingencies are removed. So we got to make sure that the trust is set up prior to the removal of all contingencies, but ideally even prior to escrow even being opened at all. However, if you're in a 1031 exchange, we can save that failed 1031 exchange if you're working with us in the qualified intermediary, who's our number1 strategic alliance. So make sure you're doing that right now by connecting with us, right? Number two is, the second part of the phase here would be actually creating the trust itself. Okay, so you want to make sure that the trust gets created and that it has its own EIN and it's ready to go prior to, again, the close of escrow, and also prior to removal of contingencies. And so creating the specialized trust is not that difficult. You just have to name the trust, and the tax attorneys and Capital Gains Tax Solutions, we work together to form the trust. And essentially then we're going to weave the trust into your purchase and sale agreement, your APA, working with escrow to make sure that it's within the guidelines of the timing of the sale. And this will help to then give you the option to use the trust, which moves into the next phase of how this all works. You're going to transfer the assets rights to the trust. And so whether it's a business, whether it's shares, whether it's real estate, whether it's cryptocurrency, depending on how you own it, will determine how we're going to make this transfer. But essentially what's happening is you're selling to the trust before the trust sells to the ultimate buyer. And obviously doing this before the close of the sale. You'll transfer the rights, the title, the interest to the trust, ensuring that you have legally done this in the right order to not have taken what's called constructive receipt, which ultimately is what happens with tax. Okay, so the final phase of this first part would be the closing, right? Actually getting the installment contract. The designated buyer actually will buy the asset from the trust, and the trust will turn around and again, issue that promissory note. And essentially it's, let's say you sold for 10 million and the asset, you had, let's say 3 million of debt. That debt gets paid off at escrow. That's 7 million net of closing costs. Let's say that's net of commissions as well that you're paying to the broker. That would be the promissory note, right? Essentially what you would have received, the trust itself will issue a promissory note for that amount. Now, let's say you do want some amounts to come out to pay you. You can absolutely schedule a payment from the trust and you pay tax on that, right? That's fine. You might want a $500,000 or $1 million or whatever amount that you want. You can take a payment up front and just pay tax on that, but the rest of it can be deferred. So that's actually a question that we get a lot. By the way, if you're finding a lot of value in this video, I want to encourage you to please like the video. If you're watching it and consuming this on YouTube, please also subscribe to the YouTube channel. We so appreciate that. We also have the podcast that you can subscribe to as well. We so appreciate that as well. So back to phase 2. This secured installment contract is what you now own, which by the way can be part of your living trust. So if you have a living trust, it can be there and your kids can inherit this installment contract and thereby continue to defer taxes over time. Let's dive into the legitimacy and the legality of the Deferred Sales Trust. So the DST, by the way, not to be confused with the Delaware Statutory Trust, is batting 1,000. It's the undisputed champion when it comes to a perfect IRS track record so far. And this is going back over 27 years, thousands of closes and over 24 no change IRS audits, successful formal audits and individual trusts were audited. Okay, so it complies with the IRC 453 rules, which allows for spreading taxes over time and again, potentially earning from investments. So we believe this strategy is integral to the selling of appreciated assets. What assets does it work for? Well, any asset of any kind. It works for businesses, primary homes. It works for commercial real estate, cryptocurrency, public or private stock, artwork, collectibles, carried interest, captive insurance. Really anything that has $1 million net proceeds and $1 million gain, that is so key to the Deferred Sales Trust because here's the key. It has some costs, and it has some complexities, right? There's a third-party unrelated trustee. That's our role here at Capital Gains Tax Solutions. You do give up some control. In fact, you don't have unilateral control. If you did, that means you own the trust. And if you own the trust, it'd be taxable. So you're working with a third party, kind of like working like a qualified intermediary, and or if you have like a 401k, this is very common. There's like a 401k administrator. There's certain rules and procedures and compliance that we have to follow. But as long as we follow that, it falls within the guidelines of IRC 453, we can defer the tax. And so what are some of the benefits? Well, we've talked about a little bit, but not only is it going to give you tax deferral, which is number one, but it also gives you opportunities for growth and future revenue and wealth creation through partnering with the trust. In fact, you can partner with the trust to buy more assets. And so if you're an entrepreneur, the trust is perfect for you. If you're wanting to be retired and be passive, the trust is perfect for you. If you're wanting to invest in just liquid securities, the trust is perfect for you. If you would want to invest into real estate of your own or with partners, the trust is perfect for you. In fact, the trust is so flexible that it can be customized to your unique, investment strategy as well as risk tolerance. And so we love the Deferred Sales Trust for that flexibility, and our goal is to help it to align with your values and your vision for your wealth in a flexible way. So what can you do? Well, you can get started right now. You can go to capitalgainstaxsolutions.com where you can schedule a time with myself or one of our team members where we can dive into to your unique circumstance. We can find out what your main need is, and we can find out what you're trying to accomplish, as well to find out if the Deferred Sales Trust is a great fit or not. It's all no cost, no obligation for that consultation. You qualify by just having $1 million net proceeds and $1 million gain on the sale of an asset. You might have two that are $500,000 each that you can combine into one trust, and the answer is yes, you still qualify on that. So those are the two things you have to be aware of. Thank you so much for watching this video. I know it's a little bit longer. Again, if you could subscribe to the YouTube channel, that would mean the world to us, because that means we can help more people understand what the Deferred Sales Trust is and ways to create and preserve more wealth. As well, you can check out the new book we just had released. It's called Building a Capital Gains Tax Exit Plan. And we believe it's the proven playbook for helping you to unlock your ideal wealth plan for yourself or for your clients. So check that out on Amazon. We do have Kevin Harrington from Shark Tank in the book and a number of other amazing real estate and financial professionals. Thank you again for watching this video. We so appreciate everyone out there, and we will talk to you again real soon. Bye now.